Title: The Art of Survival, Mastering Position Management in Volatile Markets. Hello, this is John Mark Gray. In this video on financial markets, we are going to dissect the critical, often overlooked disciplines of position management and strategy. This topic is especially relevant right now, given the staggering number of market participants who are woefully inept at managing their exposure and possess little understanding of the precise moment to ring the cash register on a trade or investment. Rule 1. Selling into the euphoria. The first ironclad rule you need to internalize is that you always sell into strength. You sell when the momentum looks like a runaway freight train, when the asset class is at peak ebullience, and when the crowd is hysterical with joy. When everyone in the trade is high-fiving, smiling, and patting themselves on the back for being geniuses, that is the exact signal that you need to be selling into that wall of bullish euphoria. Nothing climbs to infinity. Even if an asset takes another leg up after you exit, so be it. You must evaluate trade management through a lens of rational risk-reward calculus. You can always find another trade to allocate that capital toward, oftentimes one with a much cleaner setup and better expected returns in the future. The anatomy of a crash. This is painfully pertinent today as we watch Bitcoin, gold, and silver melting down over the last couple of weeks. It is obvious that many traders have been caught flat-footed, utterly unprepared for these massive sell-offs. Traders and investors are biologically wired to only see the upside. It is human nature to think positively, to be optimistic. But let's be honest, human beings are also downright greedy, and that greed blinds them. The reason I know these market participants are poorly positioned is the sheer violence of the price action. The crashing nature of these charts reflects heavily levered positions being forced liquidated. This isn't normal selling. This is the destruction of underlying value in a terrifyingly short window. These positions are being unwound not by humans, but by cold, computer-automated risk management algorithms that automatically dump the positions of poorly capitalized traders the moment margin thresholds are breached. The leverage trap. Another critical aspect at play is the structural nature of these assets. Gold, silver, and now Bitcoin are effectively all futures markets. For example, Bitcoin has been colonized by financial institutions and taken mainstream via ETFs, futures, and other financial vehicles. These proxies for Bitcoin itself ramp up the inherent leverage in the system, acting like accelerants when the market starts to turn negative. And gold and silver are notoriously volatile futures markets. Even though they both have underlying physical markets, the futures usually lead the physical, not the other way around. Moreover, futures in general, being highly levered financial instruments, frequently have their fair share of outsized price action moves that require lots of experience to navigate successfully as a trader or investor. Rule 2. The fortress mentality. The next trading rule is non-negotiable. Never make yourself vulnerable in a market. You must never position yourself where your sizing leaves you exposed to liquidation, even in extraordinary circumstances. If you are vulnerable, you are undercapitalized. Most traders in futures markets are chronically undercapitalized. By their very nature, futures utilize leverage, and most traders get the math wrong. They miscalculate the ratio of contracts to their available account balance. This is a math problem at its core, and in the high-stakes arena of futures trading, getting this risk ratio wrong is fatal. I know this through decades in the trenches. I have witnessed countless liquidation events similar to the bloodbath taking place in gold, silver, and Bitcoin right now. This price action speaks volumes about the fragile foundations underlying these markets. In short, to trade volatile instruments like futures, you need far more capital than you think, by a large margin. Most traders learn this lesson the hard way, through the trauma of forced liquidation and capital that is erased forever, never to return. The liquidity mirage. The bottom line is that you need capital to play the game, and your primary job is to protect that capital. The best way to do this is to fortress yourself against forced liquidation. Crazy, black swan, risk-off events always occur. You need to be prepared for them while the skies are still blue and everything seems quiet. By the time you realize things are no longer safe, it's already too late. Everyone runs for the fire exits at the exact same moment. Suddenly, liquidity, the ability to sell, vanishes precisely when you need it most. That is the dirty little secret of liquidity. It is abundant when nobody needs it, But at the most crucial moment of a crash, it evaporates completely, leaving you to accept terrible prices as you try to escape a collapsing building. Conclusion: keep these two rules in the front of your mind. Always sell into strength. That is where the deep liquidity lives. And never make yourself vulnerable to the market's whims through improper sizing. You must always retain the power to exit positions on your own terms, not the broker's. Good day and good luck, traders and investors. This has been fun, as it is always a good time discussing the brutal, beautiful theory of financial markets.